Hey guys, it's Chris Mincolla with the Mincolla Group over at West USA Realty, and I'm doing our housing weekly market update. Okay, I've got a couple of big stories for you. I'm going to jump right in here. I'm going to keep this very short, I promise, I think. But Berkshire Hathaway buys Taylor Morrison. Why? Because Warren Buffett knows you own the inventory, you own the market. They're about fifth or sixth largest builder in the country. And he knows that the market is getting ready to take off. This is kind of a reset year. But right now, he knows with a new Fed chair, the economy booming, with the GDP numbers up. And then we see jobs market numbers going up, which we'll get into in a minute. Um, we see that, after this Iran thing's done, we're going to see the actual inflation rate is going to be lower than we see now. And that means we're going to see the Fed rate come down, the 10-year Treasury Fed rate, and mortgage rates come down. So that is it. And Warren Buffett is now the chairman, not the CEO anymore, but he's obviously still the chairman. So super important. Also today we had jobs report come out. High double the jobs numbers than expected. They also had a revision over the last couple of months. Those numbers actually were revised up. So we see over about five, was it 550,000 or more homes over the last, I'm sorry, jobs over the last 3 months on the upswing. We see average earnings going up. We see unemployment rate at 4.3, which is pretty normal. So with that in mind, economy's doing much better. Definitely doing better than it was over the last 2 years with the employment numbers. Housing inventory. This is the other big story, though, guys. Housing inventory has gone negative. Okay. The thing that's kind of kept things going is having mortgage rates below 7% because the 10-year Treasury and the 30-year mortgage spreads have been much better over the last year than they were 2, 3 years ago. We can see that the weekly inventory rose to 795,000 and some change, but turned negative year over year versus 803,000 last year. Of course, there was the effect of Memorial Day data that always comes into play whenever there's a holiday. Mortgage rates ended the week at 6.56%. Price cuts were 36.88%, and purchase apps were up 5% year over year. Now, what happens when inventory goes down? Who does that benefit? Less inventory benefits the seller. Okay. More inventory, if you have more inventory flooding the market, that benefits the buyer. It's harder for your home to sell. So let's keep that in mind moving forward, guys. We'll keep an eye on this, but we can see new listings. Okay. Mortgage application data has slumped off a little bit with this whole Iran thing being a little bit longer than everybody hoped for. Hopefully, this thing gets over with. We can see the national single family housing overall inventory of single family homes going negative right here, and new listings going negative right here. The spreads are still good between a 10-year Treasury, better than they were over the last couple of years, but not where we want them to be still. There should be 1.8 to 1.6. They're at 2.03%, but still much better. Otherwise, right now, rates would be well over 7%. So kiss a mortgage spread. Thank you for, Fannie, Freddie, Bill Pulte, and President Trump for putting that 200 billion into those treasury bonds earlier in the year. Now, we can see over the last week, crude oil, you know, or let's get a week here. Okay, overall, we're back down at about $90 a barrel. Okay, we need to get that back down around, at least 80, 70, back between 60 and 70 would be wonderful. We can get lower gas prices, lower energy costs. That would be wonderful. With the 10-year, with the jobs report numbers being high, and they saw that, and the 10-year Treasury went up. And today the stock market didn't do very well, but because we've got this idea that okay, uh, you know, GDP is doing good, stock market does well, we got more jobs coming online, they're getting higher pay. let's stop it all because that automatically is going to mean higher inflation, which it does not. As we know, a third of inflation is made up of shelter costs, been coming down the last 3 years. I've been showing you that chart every week for the last 3 weeks. I'm not going to show it again today, but that's how the thinking is right now. We'll see if Kevin Warsh and some of the other smarter people can get the ginned up, kind of confused stock market people back in line there, um, along with these bond traders. So anyway, that'll be a work in progress. It'll get there. Don't worry. We'll see some new models, some better data. It'll all take care of itself. Right now, though, and by the way, in let's see, 16th, 17th of June will be the first meeting for the new Fed chair. We'll see how that all goes. Hopefully, this Iran thing's done before then, but we'll see. Today's mortgage rate, 6.66. I don't like that 666, but 6.66. Know that you can get just out of the box, not any better credit score than what you're seeing here. You can get interest rates 100 to 150 basis points lower with a mortgage broker like we work with. That means 1% to 1.5% lower than that. So mid to low fives on that 30-year fixed. Also, of course, you have FHA, VA. So it would be 1 to 1.5% lower than those. Okay, right now, without even getting into buy downs or having concessions from a seller or anything like that. Okay, guys. Looking at the Phoenix market, active inventory's down, just like the national. Pending sales are down. Well, because all this stuff flows within 30 to 90 days of each other. How long have we been in this Iran conflict? Has it been, let's see, we're going into third or fourth month of that, whatever. I guess fourth month now. So of course, this is flowing into the pending data with the higher rates, and everybody, being worried, but you need to be more like Warren Buffett. Know the signs and the trends in the market. He knows inventory's going down. I need to own more inventory. He knows new Fed chair. There's going to be some changes made there. Underbelly of the inflation rate is actually flat to lower. And he knows the economy's on the beginning of the boom. By the way, on those jobs numbers too, residential construction is down because they're worried about this whole Iran thing, higher interest rates, higher Fed rate may be coming into play, unless things get fixed there. But you know, they have less residential, but more commercial construction going on. Manufacturing is doing well. We always say those are the two big indicators for any possible idea of a recession. We're not seeing that, even though residential construction went down. It's not down at any alarming rate. Okay. Closed units are up, coming, out of the spring market, heading into, mid-June here almost. By the time we get into next week, we're going to see, with these higher rates, how that all figures in. But just like the national data, we see the lower inventory. Who does that benefit? Less inventory, sellers. Less inventory, better for sellers. Lower inventory, sellers. It's all about supply and demand. Okay. So we can see all the different price points here. Actually, the luxury market in the Phoenix area is doing pretty well. We can see everything under 600,000 is the majority of the market. Okay. And we've got about, 78 days closed down market, 3.4 month supply. Anything traditionally under 4 month supply is considered a seller's market. So with less supply, we'll see how that plays out over the next few months, especially if rates do drop at any point or go up. Absorption rate, 37%, kind of mid-range there on that. 773,000 average list price, average sales price, actual sales price is 606,000. The list to sales price ratio, that means that the sellers are giving up almost 3% from their list price and price reductions. Okay. We saw Logan in the other article mentioned earlier, 36% of listings are doing a price reduction. Okay. So this is actually a good sign for sellers right here. Okay. We'll see the Cromford report maybe hasn't quite caught up with this yet. We'll see how this plays out, but the supply as of today is at 106. Between 90 110 is a balanced market. Demand right now is at 86.8. If those two numbers of supply and demand are the same, we'd be at 100 at a completely balanced market. We're at 81, which under 90 puts us in a buyer's market according to Cromford. But if those numbers keep shifting, they'll catch up. Okay. Yes, I'm saying the Cromford report will catch up because we have a pretty good inventory right now at 25,000 homes for sale. But if that number keeps going down, who's the advantage going to go to? Sellers. Again, it's just a trend line. We'll see if it trends much more in that direction, but that's where we are right now. The contract ratios. Right now we're at 35. What's actually listed active for sale. Let's take this out of here. We don't need to do the whole state. Let's just do Maricopa County. Okay. This actually puts us at 35.7. What's actually actively listed for sale and what's under contract. We would see the pendings go up if the rates went down, of course. May take, there may be a lag there of 30 to 90 days on that. But right now, we don't see too much heating up. Just a couple areas of Phoenix, kind of almost middle west Phoenix. And that's about it. Everything else is pretty warm except for down here in South Phoenix. So that's all I really have for you today, guys. We'll see how this keeps trending. This is kind of a new trend. We told you this was probably coming over the last couple of weeks, nationally and in the local Phoenix market with supply. See how that plays out. All right. We'll see you next time, guys.